So you want to buy your first home, save up a down payment, sign a mortgage, get the keys, stop paying rent forever, and start building wealth instead of handing it to a landlord. That's the plan in your head, and for most of American history, that plan was considered the single safest financial decision a normal person could make. Here's the problem. Buying a first home today looks nothing like it did for your parents or your grandparents, and the math underneath it has quietly shifted in ways almost nobody explains clearly before you sign anything. A first home is not really a purchase. It is a decades-long leveraged bet, wrapped in the emotional language of stability. And the moment you understand that difference, everything about how homeownership builds wealth and how it quietly drains it starts to make sense. Let's start with the price list, because just like every asset we've broken down before, homes come in tiers, and the tier you can actually afford is shaped by forces far bigger than your own paycheck. The median home price in the United States has climbed past $400,000 nationally, but that number hides an enormous regional split. In parts of the Midwest and the South, a solid starter home can still be found for $150,000 to $250,000. In coastal metro areas like San Francisco, Los Angeles, New York, or Seattle, that same starter home, the modest three-bedroom on a small lot, routinely crosses $700,000 to over $1 million. This isn't a coincidence. It's the same principle that determines airport slot values or luxury hotel room rates. Scarcity of land in a place people desperately want to be. And it means two first-time buyers earning identical salaries can be living completely different financial realities, depending purely on which zip code they're chasing. Now here's where the naive mental model starts to break down. You assume the hard part is saving the down payment. It's genuinely difficult, but it isn't even the biggest hurdle anymore. The traditional 20% down payment on a $400,000 home is $80,000, a number that alone takes the average American household years to accumulate. But the real shift has happened somewhere else entirely. Interest rates. A mortgage rate that sat around 3% for much of the last decade has, in the recent high-rate environment, climbed well past 6 and sometimes 7%, and that difference sounds small until you run the actual numbers. On a $350,000 loan, the gap between a 3% rate and a 7% rate is the difference between paying around $1,500 a month and paying over $2,300 a month for the exact same house, the exact same loan amount, the exact same buyer. That extra $800 a month isn't going toward your equity. It's flowing straight to the bank as pure interest, and it's why housing affordability has become less about home prices themselves and more about the invisible cost of borrowed money layered on top of them. Then there's the part almost nobody budgets correctly when they picture that first closing day: closing costs. Buyers typically pay somewhere between 2 and 5% of the purchase price just to finalize the transaction, covering loan origination fees, appraisal fees, title insurance, attorney fees, and prepaid property taxes and homeowners insurance that get collected upfront into an escrow account. On a $400,000 home, that's $8,000 to $20,000 due at the closing table, on top of the down payment itself. And if your down payment sits below 20%, you're also required to carry private mortgage insurance, an additional monthly cost that can run anywhere from $30 to over $200 a month, depending on your loan size and credit profile, existing purely to protect the lender, not you, until you've paid down enough of the loan to cross that 20% equity threshold. Here's the trap almost every first-time buyer walks straight into. You assume that once you're through closing, your monthly housing cost is simply the mortgage payment you were quoted. It isn't. The real number is called PITI: principal, interest, taxes, and insurance. And both taxes and insurance climb steadily over time in ways your original mortgage quote never fully captures. Property taxes vary enormously by state, from under 0.5% of a home's value annually in some states to well over 2% in others, meaning identical homes can carry property tax bills differing by thousands of dollars a year, purely based on geography. Homeowners insurance has climbed dramatically in recent years too, particularly in states facing increased wildfire, hurricane, or flood risk, with some markets seeing premium increases of 20 to 50% in a single renewal cycle, occasionally forcing insurers to simply stop writing new policies in high-risk areas altogether, leaving homeowners scrambling for coverage through state-run insurer of last resort programs at even higher rates. Now add maintenance, the cost that exists whether or not you ever call a contractor. Financial planners commonly cite a rule of thumb that a homeowner should budget somewhere between 1 and 4% of the home's value every single year for repairs and upkeep, roof replacement, HVAC systems, water heaters, appliances, none of which last forever, and all of which tend to fail in expensive clusters, rather than one at a time. On a $400,000 home, that's $4,000 to $16,000 a year that simply doesn't exist when you're renting, because in a rental, that risk sits entirely on the landlord's balance sheet, not yours. This is the single most overlooked shift that happens the moment you buy. You haven't just taken on a mortgage, you've taken on the entire operating risk of a building, and unlike a rented apartment, there's no landlord to call when the furnace dies in January. So where does the actual wealth-building case for homeownership come from? Because clearly it isn't from the monthly cash flow, which is frequently more expensive than renting the identical property, especially in the first several years. The case rests on two mechanisms working together over a long time horizon. The first is forced savings through amortization. Every mortgage payment splits between interest and principal, and in the early years of a loan, the overwhelming majority goes toward interest, sometimes 80 or 90% of the payment in year one alone. But that ratio flips gradually over the life of the loan, and every dollar that goes toward principal is a dollar of equity you now own outright. Essentially a forced savings account you're contributing to every month, whether you feel like it or not. Something renting simply doesn't offer at all. The second mechanism is appreciation, and this is where homeownership becomes a genuinely leveraged bet rather than a simple savings plan. If you put 20% down on a $400,000 home, and that home appreciates 5% in a year, a fairly typical long-term national average, you haven't earned 5% on your money, you've earned 5% on the full $400,000, which works out to $20,000 of appreciation against an $80,000 down payment, a 25% return on your actual invested capital in a single year. This is leverage working in your favor, and it's the single biggest reason homeownership has historically built more wealth for the average American family than almost any other widely accessible investment vehicle. But leverage is a two-way blade, and this is the part the homeownership always wins narrative conveniently skips. The same math that turns a 5% gain into a 25% return on your down payment turns a 5% decline into a 25% loss on that same capital. And unlike a stock you can sell in seconds with a few dollars in fees, a home takes months to sell and carries transaction costs of 5 to 6% in realtor commissions alone, meaning a homeowner who needs to sell during a downturn can watch their actual equity evaporate entirely, sometimes owing more than the home is worth if prices fell far enough. A situation that played out for millions of American families during the housing collapse of 2008. When home values in some markets fell 30 to 50% and foreclosure rates spiked to levels not seen since the Great Depression. Homeownership doesn't eliminate risk. It concentrates an enormous amount of risk into a single illiquid asset that you also happen to be living inside of, which is precisely why it feels safer than it mathematically is. There's also a tax dimension worth understanding honestly, because it's smaller than most people assume. Mortgage interest and property taxes are deductible if you itemize, but since a significant tax reform nearly doubled the standard deduction several years ago, the majority of American homeowners no longer benefit meaningfully from itemizing at all, meaning the tax advantage of homeownership that older generations relied on heavily has quietly shrunk for a large share of today's buyers, even as the sticker price of the home itself has climbed. Time to pull it all together and answer the actual question. Does buying your first home actually make financial sense? And how much wealth can you realistically expect to build if you do this right? In the realistic long-term scenario, a buyer who purchases a $400,000 home with 20% down, holds it for 10 years while making regular payments, and experiences typical national appreciation of around 4 to 5% annually, will have built roughly $200,000 in home equity by the end of that decade, split between principal paydown and appreciation combined, a genuinely powerful outcome compared to renting the same property and investing the difference in a typical savings account. In the difficult scenario, a buyer who purchases at the peak of a local market cycle faces a job relocation or life change within 3 to 5 years and needs to sell during a flat or declining market, can walk away having paid tens of thousands of dollars in interest, taxes, insurance, and maintenance, only to sell for roughly what they paid or less once transaction costs are factored in, effectively having rented the home from the bank for several years while carrying all the risk and none of the upside a true renter would have avoided entirely. So if you're deciding whether to buy your first home, remember the one thing that actually determines whether you win or lose this bet. It was never really about the monthly payment on the mortgage quote. It's about how long you can actually stay. Because time, not the purchase price, not the interest rate, not even the neighborhood, is the single variable that turns homeownership from a risky leveraged gamble into the most reliable wealth-building tool available to an ordinary family.